It just happened. Silver crash as gold eyes. $6,000 February 6th, 2026. A date the precious metals market will not forget. Silver didn't correct. It collapsed. Not gradually, not predictably, but in the kind of violent liquidation that only happens when leverage meets panic. And the crowd realizes there's no exit door. Gold, meanwhile, is eyeing $6,000, not despite the chaos, but perhaps because of it. What just unfolded wasn't a normal pullback. It was a message. And if you don't understand what the market is trying to tell you right now, the next move could be catastrophic. Welcome to Metal and Macro. Now, before we dive into what just happened and what it means for your financial future, let me ask you something. You've been watching markets long enough to know that real analysis, the kind that actually protects wealth, doesn't come from the crowd. If you value clarity over noise, strategy over hype, then do yourself a favor. Hit that subscribe button, not because I'm asking, but because you know what happens to those who ignore the warning signs. And while you're at it, tell me in the comments, where are you watching this from? New York, London, Singapore, Mumbai? Because what's happening in silver and gold right now isn't just an American story, it's global, and the clock is already ticking. The silver market broke on February 6th, 2026. Not slowly, not with warning signs that gave traders time to adjust their positions. It broke the way things break when too many people are standing on the same side of a boat, suddenly, violently, completely. By the time most investors realized what was happening, the damage was already done. This wasn't a dip. This wasn't a healthy correction that technical analysts love to talk about on financial television. This was a liquidation event, the kind of price action that separates professionals from amateurs, the prepared from the hopeful, the survivors from the casualties. And here's what made it different from ordinary volatility. In a normal market pullback, prices decline in steps. Sellers come in gradually. Buyers have time to assess whether the new price represents value. There's a conversation happening between bulls and bears. But what happened to silver was not a conversation. It was a stampede. The market had spent weeks climbing. Each session brought new highs. Momentum traders piled in. Leverage multiplied. Social media filled with predictions of silver reaching triple digits. The crowd grew larger. The bets grew bigger. And then the foundation cracked. When the selling began, there were no orderly steps down. There were no pauses for buyers to consider their options. There was only one direction, down. And the speed of the descent revealed something critical about market structure, something most people never see until it's too late. At certain price levels, where all the leveraged positions had placed their stop losses, where all the momentum chasers had their exit points programmed, there was nobody standing on the other side. No bids, no buyers, no floor. Just empty air. This is what professionals call a liquidity vacuum. The chart doesn't show a smooth line declining. It shows a gap, a psychological canyon where price simply disappeared, searching for the next level where real money was willing to engage. And that's the distinction most people miss. They see a red candle and think the market went down. But they don't understand what that candle actually represents. It represents forced liquidation, margin calls, automated selling, stop-loss orders triggering other stop-loss orders in a cascading chain reaction that feeds on itself. It represents the difference between people who wanted to sell and people who had no choice but to sell. The latter group always loses more. Reports from trading desks describe the scene in real time. Silver plunging through support levels that had held for weeks, traders scrambling, risk managers closing positions, algorithms executing pre-programmed exit strategies all at once. And then something interesting happened. The price snapped back, not all the way. Not enough to erase the damage, but enough to show that beneath the forced selling and the leverage unwind, there was still actual demand. Real buyers, waiting, watching. They had let the weak hands flush out. They had let the over-leveraged crowd get carried out on stretchers. And when price reached a level they considered attractive, they stepped in. This brought silver back toward the mid-70s range. Not a recovery, not a reversal. Just stabilization. A temporary ceasefire in a war that wasn't finished. Now, here's where the analysis becomes critical. The low 70s region isn't just a number on a chart. It's a psychological battlefield. This was the zone where silver had consolidated before its most recent explosive move higher, the launch pad, the base camp. And when an asset returns to its launch pad after a failed breakout attempt, the market asks one fundamental question. Are the original buyers still there? Will they defend this level? Or has something changed? Because here's what most people don't understand about technical analysis. Support levels don't work because of magic lines on charts. They work because of memory. Traders remember where they bought. Institutions remember where they accumulated. The market remembers where demand previously absorbed supply. And when price returns to those levels, everyone who missed the first move gets a second chance. But second chances come with risk. Sometimes the buyers return. They defend the level. Price bounces. The uptrend resumes. And sometimes they don't show up. Sometimes the market has changed. The story has shifted. The conviction has evaporated. And what looked like a support level becomes a ceiling on the way back down. This is the test silver faces right now. Not tomorrow. Not next week. Right now. The market is asking whether the liquidation event was simply a violent clean-out, a painful but necessary reset that clears the way for the next leg higher, or whether it was something more serious, the first crack in a structure that's about to fail completely. And to answer that question, one cannot look at silver alone. While silver was bleeding, gold was watching, not panicking, not collapsing, not joining the chaos, just watching. And that difference tells a story most investors will completely miss. Because here's what the average person doesn't understand about precious metals. They see gold and silver as twins, two shiny metals that move together, rise together, fall together. But the professionals know better. Gold and silver aren't twins. They're cousins from different worlds, with different purposes, different audiences, and different fates. What happened on February 6th proved this once again. Silver attracted the speculators, the leverage addicts, the triple-digit dreamers who thought momentum would last forever. And when reality arrived, those speculators got destroyed. But gold? Gold had a different crowd standing behind it. Not traders looking for quick profits, not leveraged junkies chasing the next moonshot. Gold had central banks, sovereign wealth funds, family offices managing generational wealth, the kind of money that doesn't panic when candles turn red. The kind of money that thinks in decades, not days. While silver was experiencing forced liquidation, gold was experiencing something entirely different. A stress test, not a breakdown, not a structural failure. A test of whether the foundation could hold when pressure arrived. And it did. Gold's price action during the same period showed volatility, yes, pullbacks, certainly, but not collapse. The support levels held, the institutional buyers remained present, the structure stayed intact. And this is where the $6,000 conversation becomes relevant, not as hype, not as prediction, not as hopeful speculation, but as a mathematical possibility based on observable market behavior. Let's examine where this number actually comes from. Over the past 18 months, a pattern has emerged in gold markets that cannot be ignored. Central banks have been accumulating, not occasionally, not as a hedge against temporary uncertainty, but systematically, month after month, quarter after quarter. Poland, China, Singapore, India, Turkey, countries that disagree on almost everything else, all doing the exact same thing with their reserves. Buying gold, reducing dollar exposure, rebalancing away from pure fiat holdings. This isn't conspiracy theory. This is publicly reported data from the World Gold Council and central bank balance sheets. And when central banks accumulate an asset consistently for this long, they're not trading. They're positioning for a future they see coming. A future where currency stability becomes questionable, where monetary policy loses credibility, where the only real money is the money that existed before governments started printing. Now add another layer. Institutional investors, the pension funds, endowments, and family offices managing serious generational wealth have been quietly increasing gold allocations. Not because they expect gold to double next month, but because they've done the mathematics on currency debasement, on unfunded liabilities, on debt to GDP ratios that can never be repaid. And the math leads to one conclusion. Physical assets with no counterparty risk become the ultimate insurance policy. So when analysts discuss gold reaching $6,000, they're not pulling numbers from imagination. They're extrapolating from current accumulation rates, from monetary expansion trajectories, from historical precedent during previous currency crisis periods. They're asking, if this pattern continues, where does price equilibrium land? And $6,000 is the conservative answer. Now here's what makes gold's current behavior even more significant. During silver's liquidation event, while leveraged speculators were being carried out, gold barely flinched. The technical structure remained intact. The key support zones held firm. The volume profile showed institutional accumulation continuing even during the volatility. This divergence reveals everything. Silver is a speculation vehicle that attracts hot money, and when hot money gets scared, it runs for the exits. Gold is a wealth preservation vehicle that attracts patient capital. When patient capital gets scared, it buys more. Different assets, different purposes, different outcomes. The business community needs to understand this distinction. Because if someone is managing corporate treasury, or personal wealth accumulated over decades of building enterprises, or family assets meant to transfer across generations, the question isn't whether gold or silver will spike higher next week. The question is which asset preserves purchasing power when the monetary system experiences stress. And gold just answered that question. While silver collapsed under the weight of leverage and speculation, gold held its ground. While momentum traders in silver got liquidated, institutional buyers in gold kept accumulating. While silver tested whether its foundation could survive, gold proved its foundation was never in question. This doesn't mean silver is finished. That's not the point. The point is that gold and silver serve different functions in a portfolio, attract different types of capital, and respond differently to market stress. Gold is the anchor, the foundation. The asset, serious money, turns to when uncertainty rises. Silver is the leverage play, the speculation vehicle, the asset that amplifies, moves in both directions. And right now, while silver fights for survival at critical support levels, gold is quietly eyeing $6,000, not through hype, not through momentum trading, not through social media excitement, but through the slow, methodical, relentless accumulation of the world's most patient and informed capital. Central banks don't chase breakouts, they build positions. And right now, they're building positions in gold. While silver's crowd runs for the exits, gold's crowd is just getting started. That divergence is the real story. There's a force in financial markets that most people never see. It doesn't appear on silver charts. It doesn't show up in gold technical analysis. It doesn't announce itself with dramatic headlines, but it controls everything. Every commodity price, every currency pair, every global trade flow, every single move in precious metals is ultimately a conversation with this invisible force, the US dollar. And what happened to silver on February 6th wasn't just about silver. It was about what the dollar was doing while everyone was staring at metal charts. Here's what most investors completely misunderstand. They think commodities have their own independent price discovery. They believe gold rises because of demand. They assume silver falls because of selling pressure, but that's only half the story. The other half, the half that actually determines outcomes, is the dollar, because every commodity on Earth, oil, copper, wheat, gold, silver, is priced in dollars, which means when the dollar's value changes, every commodity's price must adjust, not because the commodity itself changed, not because supply or demand shifted, but because the measuring stick changed. Imagine trying to measure a room with a rubber ruler that keeps stretching and shrinking. The room hasn't changed size, but your measurements keep changing. That's what the dollar does to commodity markets. And right now, the dollar is doing something most people aren't paying attention to. It's strengthening, not dramatically, not with the kind of explosive move that makes headlines, but steadily, persistently, methodically. And that silent strength is the invisible hand that just crushed silver. Here's the mechanism most people never learn. When the dollar strengthens, it takes more of any commodity to equal $1, which means commodity prices, measured in dollars, must decline. This isn't opinion. This is mathematics. A stronger dollar mechanically pressures commodity prices lower. But there's another layer that makes this even more dangerous. Leverage. The global financial system runs on borrowed money. Traders use margin, institutions use derivatives, speculators use futures contracts, and almost all of that leverage is denominated in dollars. When the dollar strengthens, borrowing costs effectively increase, margin requirements tighten, leverage becomes expensive, and when leverage becomes expensive, positions get closed. Not because traders change their minds about silver's long-term value, but because they can no longer afford to hold the position. This is what professionals call a carry trade unwind. Money that was borrowed in dollars to buy assets priced in dollars suddenly faces higher costs. And when enough positions unwind simultaneously, you get liquidation events. Exactly what just happened to silver. Now let's talk about what's driving dollar strength right now. The Federal Reserve's policy stance hasn't shifted dramatically. Interest rates haven't spiked overnight. But something more subtle is happening. Global capital flows are changing direction. For years, money flowed out of the United States, chasing higher yields elsewhere. Emerging markets, European bonds, foreign assets. But when uncertainty rises, when geopolitical tensions increase, when financial stability comes into question, that money comes home. Back to dollar-denominated assets, back to U.S. treasuries, back to safety. And when trillions of dollars in capital shift direction, even slowly, the currency moves, the dollar strengthens. Not because of policy, not because of economic growth, but because of fear. Fear brings money home, and home is the dollar. There's another factor most analysts overlook, the offshore dollar market. Eurodollars, dollar deposits held outside the United States, the shadow banking system that operates beyond Federal Reserve control. And this market is enormous, larger than the domestic dollar supply. And right now, offshore dollar demand is rising. International businesses need dollars for trade settlement. Foreign banks need dollars for regulatory requirements. Global corporations need dollars for debt service. And when offshore dollar demand rises, while supply remains constrained, the dollar strengthens. Which brings us back to precious metals. Gold and silver don't exist in isolation. They trade in a dollar-dominated system. And when that system experiences stress, when dollar demand spikes, when capital flows reverse, metals face headwinds that have nothing to do with their intrinsic value. This is why understanding the dollar is essential for anyone analyzing commodity markets, because the dollar determines whether a pullback becomes an opportunity or a trap. If the dollar continues strengthening from here, metals face continued pressure, not because metals are fundamentally weak, but because the measuring stick is getting stronger. Every ounce of gold, every ounce of silver becomes relatively more expensive in dollar terms, which means demand must adjust, prices must decline, until a new equilibrium is reached. But here's the critical question. What happens if the dollar reverses? What happens if the forces supporting dollar strength suddenly shift? What happens if capital flows change direction again? If offshore dollar demand eases? If the Federal Reserve's policies finally break something in the financial system? Then everything inverts. A weaker dollar means commodity prices rise, not because commodities became more valuable, but because the measuring stick shrank. And if the dollar weakens significantly, if confidence in fiat currency erodes, if the monetary system experiences real stress, then gold's march toward $6,000 becomes not just possible, but probable. And silver's liquidation event becomes not a breakdown, but a flush before the next explosive move higher. This is why the dollar is the invisible hand. It determines outcomes without appearing on the charts people obsessively study. It controls price action without making headlines. It decides whether metals collapse or explode. And right now, the dollar is sending a message: strength, stability, safety. But experienced observers know something the crowd doesn't. Dollar strength built on fear is fragile. It persists until the fear changes, until confidence shifts, until the narrative breaks. And when it breaks, the reversal is violent. For now, the dollar's invisible hand is pushing metals lower, but invisible hands can change direction. And when they do, those who understood the game being played will be positioned for what comes next. The liquidation is over. The damage has been assessed. Now comes the part that separates wealth builders from wealth destroyers. What happens next? Because here's what most people get completely wrong about market crashes. They think the crash itself is the danger. But the crash isn't what kills portfolios. What kills portfolios is the decision made immediately after the crash. The panic exit at the bottom. The revenge trade trying to recover losses. The emotional positioning that ignores what the market is actually saying. This is where fortunes are lost. Not in the fall, but in the response to the fall. So let's talk about what the silver liquidation event actually revealed. Not what people hope it means, not what fits a preferred narrative, but what the evidence actually shows. First, the market structure was tested under extreme pressure, leverage was unwound, weak hands were flushed, momentum chasers were liquidated. This is painful, violent, uncomfortable to watch, but it's also necessary, because markets cannot sustain vertical moves built entirely on speculation and borrowed money. Eventually, physics reasserts itself. Gravity returns. The excess gets purged. What matters now is what happens after the purge. Does the asset find support and rebuild, or does the structure continue deteriorating? The evidence so far shows something important. Silver found buyers in the low 70s region, not weak buyers, not desperate bottom fishers hoping for a miracle, but calculated buyers who waited for the panic, let the forced selling complete, and stepped in at levels they considered attractive. This is how professionals operate. They don't catch falling knives. They don't try to predict the exact bottom. They wait for the liquidation to finish. They wait for volume to spike and then decline. They wait for the emotional sellers to exhaust themselves. And then, when price reaches a predetermined zone, they execute. What just happened in silver fits that pattern. Sharp decline, volume spike, partial recovery, stabilization. This doesn't guarantee a reversal. It doesn't mean silver immediately resumes its uptrend, but it does mean the worst case scenario. A complete structural breakdown hasn't materialized yet. Now let's talk about the framework for what comes next. There are two possible paths from here. Path 1, silver reclaims and holds the low 70s support zone. If this happens, if buyers continue defending this level, if volume shows accumulation rather than distribution, then the liquidation event becomes what professionals call a shakeout, a violent but temporary flush that removes weak hands and resets the market for the next leg higher. History is filled with examples. Assets that experience brutal sell-offs, only to recover and exceed previous highs within weeks or months. Why? Because the liquidation cleared out the over-leveraged crowd, created better positioning, established a stronger foundation. This is possible for silver, but it requires evidence, not hope, not wishful thinking. Evidence means higher lows. It means buyers stepping in at progressively higher levels. It means the market proving, through price action, that demand still exists. Path 2, silver breaks below the low 70s zone decisively. If this happens, if the support fails, if selling pressure returns and overwhelms the buyers, then the narrative changes completely. A break below support doesn't just mean lower prices. It means the entire uptrend structure is compromised. It means the market is signaling that something fundamental has shifted. Maybe dollar strength intensifies. Maybe global liquidity tightens further. Maybe the speculative appetite that drove silver higher has genuinely evaporated. Whatever the cause, a decisive break lower would require a complete reassessment. Not panic, not emotional reaction, but honest acknowledgement that the trade has changed. This is where discipline separates professionals from amateurs. Amateurs hold losing positions, hoping they'll recover. They average down into deteriorating structures. They refuse to accept new information. Professionals have predetermined exit points. They follow the evidence. They adapt. Right now, the evidence hasn't confirmed either path. Silver is in the battle zone, testing support, fighting for survival. And until the market decides, positioning should reflect uncertainty. Not fear, not greed, uncertainty. Which brings us to gold. While silver fights its battle, gold continues eyeing $6,000. This target isn't guaranteed. Markets don't move in straight lines toward predetermined destinations, but the structural factors supporting gold remain intact. Central bank accumulation continues. Currency debasement concerns persist. Geopolitical uncertainty provides sustained demand. And most importantly, gold's technical structure never broke the way silver's did. For business leaders, entrepreneurs, wealth managers, the lesson here is critical. Gold serves as the foundation, the anchor, the asset that preserves purchasing power when monetary systems experience stress. Silver serves as the leverage multiplier, the speculation vehicle, the asset that amplifies gains in bull markets and amplifies pain in corrections. Different tools, different purposes, different risk profiles. A properly structured portfolio understands this distinction. It doesn't bet everything on silver's momentum. It doesn't ignore gold's stability. It balances both based on risk tolerance, time horizon, and strategic objectives. Now here's what matters most going forward. The precious metals market just sent a signal, not about silver specifically, not about gold's next move, a signal about broader market conditions. Excessive leverage exists throughout the financial system. Liquidity remains fragile. Volatility is expanding. These conditions don't resolve quickly. They evolve over months and years. And in volatile environments, two strategies consistently win. First, patience. Waiting for clear signals before committing capital. Avoiding the temptation to predict exact bottoms or tops. Second, preparation. Having predetermined entry points. Knowing exit criteria in advance. Following the plan regardless of emotion. The silver crash wasn't the end of the precious metals story. It was a chapter. A painful reminder that markets built on leverage and speculation eventually face reckoning. But reckonings create opportunities. For those who understand market structure. For those who let the crowd panic while they analyze. For those who position for probabilities rather than certainties. The next few weeks will reveal which path silver takes. Recovery and resumption, or breakdown and capitulation. Gold will continue its methodical march, supported by the kind of capital that doesn't panic, and the dollar will keep playing its invisible role, determining outcomes from behind the curtain. For the business community, the lesson is clear. Markets provide information. Professionals interpret that information. Amateurs react to it emotionally. What just happened in silver was information, a stress test, a liquidation, a market resetting itself. How investors respond to that information will determine who builds wealth and who destroys it. The crash happened. The panic completed. Now comes the real game, positioning for what the market reveals next.